Let's learn the policy stance. Restoring equilibrium in the financial market by decreasing money supply and hence gradually contracting demand to avoid any future disequilibrium in goods and services market. In view of the rising food inflation and the risk of it impinging on inflationary expectations, the Reserve Bank embarked on the first phase of exit from the expansionary monetary policy by terminating some sector-specific liquidity facilities and restoring the statutory liquidity ratio (SLR) of scheduled commercial banks to its pre-crisis level in the second quarter review of October 2009. The process was carried forward by the second phase of exit when the Reserve Bank announced a 75 basis points increase in the CRR in the third quarter review of January 2010. As inflation continued to increase, driven significantly by the prices of non-food manufactured goods, and exceeded the Reserve Bank's baseline projection of 8.5% for March 2010, made in the third quarter review, the Reserve Bank responded expeditiously with a mid-cycle increase of 25 basis points each in the policy repo rate and the reverse repo rate under the LAF on March 19, 2010. The monetary policy response in India since October 2009 has been calibrated to India's specific macroeconomic conditions. Accordingly, policy stance for 2010-2011 has been guided by the following four major considerations. In the emerging scenario, where consumer demand is expected to pick up along with firms' investment demand, lower policy rates can complicate the inflation outlook and impair inflationary expectations, particularly given the recent escalation in the prices of non-food manufactured items. Despite the increase of 25 basis points each in the repo rate and the reverse repo rate, our real policy rates are still negative. With the recovery now firmly in place, we need to move in a calibrated manner in the direction of normalizing our policy instruments. Inflation, which was earlier driven entirely by supply-side factors, is now getting increasingly generalized. There is already some evidence that the pricing power of corporate has returned. With the growth expected to accelerate further in the next year, capacity constraints will re-emerge, which are expected to exert further pressure on prices. There is, therefore, a need to ensure that demand-side inflation does not become entrenched. Notwithstanding lower budgeted government borrowings in 2010-2011 than in the year before, fresh issuance of securities will be 36.3% higher than in the previous year. This presents a dilemma for the Reserve Bank. While monetary policy considerations demand that surplus liquidity should be absorbed, debt management considerations warrant supportive liquidity conditions. The Reserve Bank, therefore, has to do a fine balancing act and ensure that while absorbing excess liquidity, the government borrowing program is not hampered. Against this backdrop, the stance of monetary policy of Reserve Bank is intended to anchor inflation expectations while being prepared to respond appropriately, swiftly, and effectively to further build-up of inflationary pressures. Actively manage liquidity to ensure that the growth in demand for credit by both the private and public sectors is satisfied in a non-disruptive way. Maintain an interest rate regime consistent with price, output, and financial stability.